Hi, everyone, and welcome to the Week Ahead. I'm Tony Nash, and today we're joined by Tony Greer. Tony is with TG Macro. He does the Morning Navigator newsletter. He's an OG with Real Vision, and he's just, very, very popular, and we're really lucky to have him today. We have Marko, of course, and Tracy Shuchart. We're very fortunate to have both of them today. So thanks, guys, for taking the time to talk with us today. I really appreciate it.
My pleasure. Thanks for asking.
Great. So we're going to start today with Albert. We're going to be talking about inflation. We just had Albert. You've said several times over the past several months that we're going to have kind of a reacceleration of inflation this year, and we just had an upward revision of the December CPI, and of course we have another CPI. The Jan CPI is out on Tuesday. There was a viewer question talking about kind of your inflation 2.0 thesis. Can you talk us through that? Like, what are you thinking of when you think through that, and when do you think it'll materialize?
I'm looking at multiple variables at the moment. Russia probably reactivating some of the military operations in Ukraine, which I think we started to see the last couple of days, a little bit. We have China reopening. The Europeans have been in a zombie state, so they're technically reopening, so their demand is coming back. All that's going to be inflationary, in my opinion. But the biggest factor that I see has been Yellen's use of the TGA to offset QT.
Okay, what's the TGA?
Well, the Treasury General Account. So she has a big slush fund of money where she can place wherever she wants. And what that's been doing has been helping rally the markets, purely out of political reasons. And when you have a net zero quantitative tightening cycle, it's like, what do they expect that to happen at the moment?
Okay,
I mean, she's gone.
Let me back up just for people who aren't, so we had a Fed meeting last week. They raised by 25. They're continuing QT incrementally, right? And so what you're saying is that Yellen is offsetting that QT with spending from the TGA.
Yeah, it's exactly what I've been saying.
Okay.
So I've been saying this for quite a long time, and she's gone hog wild on the Treasury bills in the recent months, and that's pretty much the reason we got a stock rally. You're looking at the duration of liquidity, which is very, very important, and nobody really wants to talk about that at the moment. So, I mean, these stock rallies have given a perception of a solid market and an overall economy aiming to help the Biden administration for purely out of political reasons, in my opinion. Right, and this revision. Yeah, it was revised, and people think it's an incremental revision, but it's a 33% rise in CPI for the previous data. So it's not incremental whatsoever.
Yeah, month on month, it's a little bit elusive for people to understand how big of a revision this is. Whenever economic data come out, anybody who follows me knows I always say wait for the revision, right? Especially with OECD countries, wait for the revision, because they hide stuff and they leak it out in previous data, other things. And so, as you just said, Albert, there was a 33% revision in the December CPI. That's massive, right?
Yeah, wage inflation is spiraling out of control. I mean, not just the United States, but now you have the Bank of Japan reporting more inflation from their side. So, I mean, in fact, the Australians did the same thing. They're having hot CPI numbers. I mean, if we have a hot CPI number coming Tuesday, I mean, it's just not going to be pretty for equities, in my opinion. And I think that's why Jerome Powell went soft last week. It's just because he sees the data and he knows what's coming.
So what is a hot CPI number to you?
I think anything above what the consensus is, whether it's even 0.1 or 0.2, anything that's sticky in the core CPI is going to be hot.
Tony, you're wincing there. Why do you do that?
But no, I mean, I was hoping for a specific magnitude. You know what I mean? As a trader, I'm like, how much higher is he expecting? And he was anything higher. And I was like, 8%, 9%, 10%. What are we looking at? That's all. I'm very interested. I think he's on the absolute right track.
Yeah, I mean, it's hard because, they've been using, the BLS has been using different calculations and methodologies to calculate CPI. I mean, they just changed the way they weigh it. So, they're trying to keep it within a reasonable amount. But, when you're looking at fertilizers and fertilizer companies like Mosaic, and then you have natgas spiking and then wheat spiking today, either that's Russia ramping up military affairs in Ukraine, or there's a hot CPI number coming, in my opinion, or both.
Okay. How much of a factor is like the earthquake in Turkey, or is any of that a factor in?
Oh, that's a huge factor, Tony, because that's going to start cutting off. That's going to start off cutting oil supply, and that's one of the prime components of inflation. And I'll let Tracy get onto the details of that, but that's one in many variables that we're going to start looking at.
Okay. And so when you say inflation 2.0 is coming, are you looking at, say, Q2 or something when that will kind of reemerge, or what's your timing on that?
I'm thinking Q2 at this point. Originally, I thought it would be in September or October, but I think the timelines definitely come faster.
Okay. And so what's driving that is largely kind of energy and ag. Is that
energy, ag, and specifically just the market just being rallying relentlessly. It just won't go down, and that's spurring commodities. Copper, oil, you name it, wheat, grains, everything.
Okay, so if I understand you correctly, just to reiterate what you said, we have more money going into the money supply because of the spending from the TGA. That's offsetting QT, and that money in the money supply is going to people who are driving up commodity prices, driving up equity markets, and potentially driving up real estate, right? Because we saw some real estate numbers this past week that were not discouraging, right? I mean, real estate isn't dying like many people thought right now, and mortgage rates are generally kind of going down. So it seems like we have money going into those things, which is kind of the opposite of what the Fed chair are trying to achieve.
Yeah, you could, the mortgage rates ticks down just a little bit, and all of a sudden the spurs on buying. So, I mean, it's just everything that the Fed has been trying to do is just not happening. Labor, housing, stocks, everything, literally everything.
Okay. And so how much longer can Yellen use the TGA? Does she have unlimited capacity there?
No, she doesn't. And Congress can definitely put on oversight on that. But she started off and had, well, not started off, but she had about 160 billion per month just prior to the midterms. But now she's down to about 50, 60. But that'll get replenished in April when the tax money comes in for the use. So
okay. Okay. So it will be muted in March, but
that's right.
She can just go guns blazing again in April.
Yep, and this is part of the negotiations with the budget with the Republicans and the Democrats is trying to limit what she can do with the TGA at the moment. I mean, they won't say that. They won't say it publicly, but they're certainly trying to.
Okay, very interesting. Okay, so for those of you guys out there, check out the Treasury General account and just see what's out there. I think that would be really interesting to look into. Okay, anything else on this, Albert? Like, is inflation 2.0, is it going to hit the US worse than it hits, say, Europe or Asia, or like where do you think
I think Asia and Australia is up first for inflation and then leaking over the United States. Obviously, I don't think we're going to see 9.9 prints on the CPI, but steady 6-7, we definitely see that.
Okay, great. All right. And then do you think that tapers off in, say, Q4, something like that?
I think so. I think it'll start tapering off again. I think it's going to be in a cycle.
Okay, great. All right. So we just I just tweeted out our complete intelligence CPI print expectations for the year. And we think on average, we're going to be about 5.3% for the year. So we're probably a little bit below your expectations. So, all right. Albert, thanks very much. I really appreciate that.
Thanks,
Tony. Let's move on to you. When we spoke before this discussion, you talked about market chaos like you enjoy it. Are you having fun with this?
Yeah, I am. It's gone. This is the kind of trading that benefits a more active trader. I think, like me and somebody that's not afraid to get flat things and, take advantage of what look like, absurd price opportunities in the immediate term and things like that. So yeah, I'm having a good time with this, Tone. I really am.
That's great. Can you talk us through kind of, you seem to indicate that you're pretty bullish on metals and oil. So can you help us through that? And let's look at metals first. I've got a chart for copper up. And that price has obviously come down recently, but why are you so bullish on metal? Is copper included?
Yeah. So let's go right into it, Tone. The copper is definitely included. What got me so bullish was last year. I remember spending the whole entire second half of 2022 watching copper pound 6,500 on the LME, right? And for me, that equates to the 2017 and 2018 peak in copper, from which point it failed and faded lower and then traded down below 5K during the lockdown, right? So we saw the big spike to 11K where everybody thought copper was going to the moon. All of that was essentially the lead in to the Biden administration, right? That was the lead into the Biden administration. The pivot to electronic vehicle was that big copper rally to 11K, and it consolidated there for the entirety of 2021. Right. Then in 2022, copper backed off and pounded that the highs from 2018 at 6,500, held and got back up above its moving averages. So when you see that and it coincides with another fairly tight physical market, another backward dated commodity, another commodity where inventories are nosediving. So you've got the supply side really on your side. The sort of argument against that is that China is storing and taking a lot of copper off of inventory. And my response to that is, if they're taking it off inventory, they're probably not going to sell it anytime soon. So I don't have to worry about it. So that's kind of, the sort of one basic slant of my metal bullishness, right? On the other side of it, I have, in my mind, I'm fairly convinced that the dollar is going to be on a path lower this year. If you noticed last year, she peaked at the Bank of England intervention when the gilt market came apart. And then she formed a lower high when dollar yen got to 150 and the Bank of Japan showed up and said, hold on. You guys are killing us, right? You know what I mean? That was an absolutely, inexplicable FX rally that people haven't seen in decades. So with those two central banks at the top, Tone, a curl down below the moving averages, and coincidentally, with the backdrop of two stories, number one, central bank digital currency story seems to be gaining traction, whether we like it or not, right? Whether it's good for us or not,
right?
I feel like we're going to have those, right? And that's going to detract from the purchasing power of the dollar again. And then I've got the story, you've got the story where it seems like Russia, Saudi Arabia, China, and the rest of the BRICS are very interested in starting their own commodity markets priced in their own currencies.
Oh, don't get Albert started on that.
Yeah, exactly. I was going to say, I don't know if that's a fair topic for discussion, and maybe he may be a perma petro bull dollar, and that's fair too. I don't know. But I see that as a story as sort of deteriorating credibility in the dollar, certainly. And that's just the way I'm leaning. And it's not something where my money is where my mouth is. The dollar for me is a barometer that tells me how much wind am I going to have in my commodity sales. Yep. So I do not have any risk on in the dollar. So no comment.
Okay. Yeah, we should actually come back and talk about that at some point in detail. Sorry, Tracy, you were saying?
I was going to say, we should also factor into this conversation the fact that we've had the lack of CapEx in the mining industry as far as the metals are concerned.
Yep.
That is equal to the same lack of CapEx that we've had in, say, the oil industry. So that definitely factors into the situation as well when you're trying to transition to EVs, EV charging stations, and all of these metals, even windmills, as far as, say, copper is concerned, et cetera. The mining industry, again, I don't know how you feel about that, but I just want to kind of throw that in there that
couldn't agree more.
The only thing I have to say about the dollar moved down and up is I do agree with Tony that I think the dollar will probably go down a little bit. I'm probably 97, 98, right? But unfortunately, if inflation comes back, they're going to have to use the dollar to kick it in the rear. So we could see a $97, $96 and then go right back up to 105 as they try to fight inflation again. It's certainly possible. This is going to be a topsy-turvy year, no matter which way you look at it. Whether it's going to be dollar up, dollar down, commodities up, down. It's just going to be all about the Fed and what intervention they do with inflation.
It's non-linear chaos, right? The curve.
Oh yeah, but this is great for a trader. For a trading,
Right.
This is fantastic. You want to see volatility.
Yep. Very good. Okay, Tony, let's move into oil then. You're also seem to be very bullish crude, and we have a tweet from you from Jan 17th talking about crude going through its 50-day moving average and so on and so forth. Talking about some serious muscle in crude markets. So can you talk us through that as well?
Yeah, so I that's strictly a technical look, and to me, I mean, oil continues to make bottom formations and fail, right? That's what it keeps doing. We keep seeing an inverted head and shoulders, and then it can't break the moving averages, and then we see another inverted head and shoulders that's even shallower than the last one, because they can't pound it any lower, and that can't break the moving averages, and we back off. And now we've got another situation where we've got another pattern that's extremely bullish, where we just had the recent low fall between the last two lows, Tony. And that's a little bit of tea leaves, but that formation is called a wiggle. And we haven't traded lower since we put in that low that was between those two lows, if you notice. And so now we're attacking the 100-day moving average. I mean, this could be it. I walked into this year saying, technically, I'm not going to miss out on the trade where crude oil goes through the 50-day, the 100-day, the 200-day, and keeps going, right? That's the trade I've got a bullseye on. And if I have to stop myself out of it 10 times, I'm going to be in it the 11th time. I can guarantee you. So that's how I'm looking at the world. From the supply side, the driver to me has been gasoline demand, quite honestly. Mm-hmm. Gasoline demand globally is sort of, everybody's concerned about the recession now, not concerned about recession. I've traded through dozens of recessions, and I have noticed that many of them don't put a major dent in gasoline demand. Yep. So I feel like we're set up for that type of move again, where we have, steady gasoline demand. We're able to keep this crack spread elevated at a $30 to $50 level where they used to be $8 to $12, right? That's the margin that a refiner makes for splitting barrels of crude into jet fuel and diesel. So with that crack spread remaining elevated, the rest of the curve remaining backwardated, although that's another trip that's going to be nonlinear and wacky. But, with inventories largely diving below 5-year average inventories across the board, the demand for diesel, the demand for jet fuel, demand for diesel was last year. This year, it seems like demand for jet fuel is really coming back quite a bit. So I just see a great supply side story, a fairly good, demand side story. And I see resource nationalism everywhere I look. And that's generally positive for crude oil. So when you line all of that up, the stars align with the technical picture. When we do eventually go skipping through those moving averages, the stage is set for it not to come back. I don't know if that's going to happen, but as a trader, I'm going to put my chips in that circle and see what happens.
Sounds very solid. Tracy, I see you agreeing pretty violently. What else do you have to add there?
Yeah, I want to hear what you're adding, Tracy. Let's go.
No, I absolutely agree. I mean, when we talk about the supply side and the demand side, we really have to take a look at China. And I know we keep talking about the China opening story. But if we do really look at mobility data, and I posted a couple of charts on this today, mobility data is up, right? And then you also have what I think is more important is if you look at flight data and jet fuel demand, which is up once again, because we know that for Chinese New Year, we had a lot of domestic demand increase, but what we're really looking for is international demand increase, right? And so we've recently seen China flights to Hong Kong increase tenfold because they were that flight pattern was shut down, and so I think this is going to be a major forecast, and we have to realize that China has been drawing down on their stocks locally, right? And so eventually they're going to have to rebuy on the international markets because they've been depending on the stocks that they accrued since they've been shut down over the last year. If they're pulling down those stocks, China is one country that is not the US, let's put it that way. They do not want their SPR to go to zero, right? They really depend on this. And so because they've had to draw down on their domestic stocks, I would be looking for them to start buying on the international market again, especially when they're getting really cheap crude oil right now from Russia. And so it seems, apropos they would start buying again. And this is
when do you think that is?
I think now they are buying. They're buying now. I'll post some charts on Twitter again, but yeah, according to Vortexa data, there is a lot of seaborne crude going to China right now. We know that they get a lot of nat gas domestically through a pipeline, and they're expanding those pipelines, but realistically crude oil is still seaborne, and so we can track that.
Okay, interesting.
Yeah, Tony, it's a lot of people sit there and criticize it, like, well, China's been open and they're not doing anything and blah blah blah, but it's not a black or white thing with China. I mean, they're staggering their opening. They're not dumb, because if they open just full speed ahead, they'd have a commodity inflation issue even worse than the United States would. So they're not, they are buying. And I agree with Tony with the oil bull market case. And I agree with Tracy, the supply side, demand side's heavy. The Chinese are reopening and buying still. And I think oil, goes to minimum 110 this year, minimum.
I love it when Albert says, I agree with Tony, because I'm not used to hearing that, but I know he's talking about you, Tony Greer.
Well,
that's fine.
The better looking Tony.
Beautiful part. Yeah, the beautiful part about this market, Tony, is that you can find the opposite side of your trade. You just got to open your eyes and ears, right?
Yep.
But that's what you really need to do, because if you want to, if you have a thesis, you really want to hear the opposite side, right? Because
so tell me about that. What is the downside thesis for oil? What is that downside thesis?
Drill, baby, drill.
Yep.
That's not politically viable. That's the problem.
Which is not going to happen. But
that's the problem.
Bingo. Right. So that's why, that's why, you say you can get annoyed at what's going on, or you can make moves in the market, right? You can buy the energy complex and buy oil, because that's the direction it's naturally going to go if they're going to try to put this electric vehicle squeeze on by 2030. Right. I mean, that's almost a necessary, almost a necessary trade is for the Bloomberg Commodity Index to go up 40% from here, if we're going to fill all these orders to build battery packs and battery power all over the world.
The only other downside for oil is if the government starts playing around in oil futures and trying to sell it down just to keep it relatively sane on the inflation front, which they did.
It was remarkably effective. It was remarkably effective what they did with the SPR. You have to say, whether we like it or not, they knocked $30-40 off the price. It
wasn't just the SPR though. They were sitting there selling down in oil futures, in the market.
I'm
just
sure.
a lot. Yeah. So
they have a president's working group that's allowed to do that. I'm sure they are.
Yes, they do.
Free market capitalism. You got to love it, right?
Yeah.
Well,
free market, political driven capitalism.
Well, this is what Tony was mentioning. This is what Tony was talking about when he said nationalizing commodities and whatnot. Of course, there are inflationary effects, but the governments only care about short term. What's going to make my voters happy for the next election in 6 months. That's all they care about.
It's kick the can theory, right?
Yep.
We've seen this. The Fed does this all the time. We see central banks do this all the time. Why not governments, right?
Yep. Okay, guys, let's move on to crude oil specifically. Tracy, on Friday, we saw Russia announce plans to cut production to 500,000 barrels a day. Brent rose on the news, and I'm really curious, what is Russia producing right now? So are they at that volume capacity, and what does that mean for the crude quota and the price cap?
Well, Russia is already producing at their quota, according to the OPEC plus thing. The thing is their OPEC quota, and I won't get into the logistics of this, but their OPEC quota is a lot of condensate as well, not straight oil. But aside from those details, we have to go in fact, Russia, Urals is trading literally between $40 and $45 right now as we are speaking today on Friday. What date is this? I just want to make sure, so people, the 10th of February. And so I think that you have to, I think what Russia is trying to do right now is try to bump up the price of oil for themselves, because I think, if oil prices are higher for them, even though they are supplying less, they're going to make more money regardless. I also think that this puts a thorn in the side to the West, because they're trying to bump up oil prices when Western nations are trying to push down oil prices, right? They don't want to see inflation go higher, and energy is a big part of that, even though central banks don't realize that. But we have to, it is a big part of the inflation factor. And so what I think they're trying to do is basically say, I'm going to be a thorn in your side. We're going to kick up oil prices. I'm also going to benefit myself because oil prices are going to go higher for me. And maybe they reach the cap, $60, because they're well below. Then, they're still making more money with reduced volumes.
Okay, so Urals trades at a $20-ish discount, right? At this point. And so
to the price cap.
Right.
Right.
So, but who are they hurting aside from, say, India and China and a few other countries that are their traditional allies?
Well, there's still, it's still, even if that price went up of Urals at this juncture, China and India are still getting great deals, right? At $60 a barrel, you're still getting a great deal, right? You're still $20, $30 below what Brent and WTI are trading at. And so I don't think that really matters to them as far as, am I going to lose China and India as customers? I don't think that's even a concern of theirs, because they realize that their oil is trading well below everybody else.
So I guess if they're going to have the same customers, the China-India customers generally, why does it matter? Like, aside from, why does it matter to Brent that Russia's raised or capped off their production?
Well,
if it's going to go to the same markets anyway, I'm just curious, why does it matter to the non-Urals crude?
Because you're taking barrels off the market, and that is the only thing the market looks at. So how many barrels are you taking off the market, right? If you're taking 500,000 barrels per day off the market, then these other, that's 500 barrels per day off the market.
Sorry, what are they producing now? I'm sorry, you may have said this before. What are they producing now?
They're at about 10.5, but again, that includes condensate. So it's not exactly 10.5 million barrels of oil per day.
Okay.
And Tracy, how's that earthquake in Turkey affecting things on the supply side?
All right, so if we look at Salem ports, we've taken 8,885 barrels per day off the market as well. So almost 1 million barrels per day off the market from that specific port. That specific port was supposed to be down for 2 to 3 days. That's looking like a lot longer at this junction.
Okay.
So that's also affecting global markets.
Okay, so between Russia and the Turkey earthquake, there's a real impact on markets.
Absolutely.
Okay.
And of course, they'd probably take advantage of it. That's the way things work in that part of the world.
Of course. Tracy, we had some viewer questions about natgas. There were probably 4 of them on Twitter. What new insights do you have in natgas over the last couple of weeks?
Well, I think, as far as natgas is concerned, everybody's asking, when is this market going to bottom, right? Because it's been just a disaster since summer.
Right.
We've seen like over 40% decline. And in my opinion, really what we should be looking at right now, I think we'll probably consolidate down here for for a while. And I think what we should be looking for is going into summer, because what I think is going to happen is that we're going to see China demand increase because they're coming back online, and cargoes that were bound for the EU will probably go to China now. They'll outbid the EU because EU is basically full at this juncture, right? So they don't really need the cargoes. Those cargoes can move to Asia. But during the summer, what we may see happen is increase. And, we got very lucky with the EU as far as winter was concerned. And what I think will happen is during summer, if we have a particularly hot summer, air conditioning rises. That means that gas increases. And so what I think, we could see is, somewhere this summer, we see an increase in prices again, because you have to realize that last year, EU still had 50% of their capacity filled from Russia before everything went offline. That's gone.
Right.
And so, everybody, so I would be looking more towards this summer if you're looking for any sort of kind of price increase. And generally right now, I think that we're probably going to see some consolidation down in this 250 area, which is, where it's traditionally traded.
My neighbors in Texas need more money, so let's get that pumping. So
well, the thing is that at this, the producers in Texas, that their costs are higher, that production is gonna drift if we stay up long enough. And so you have to think about that as far as production is concerned anyway. I mean, we are in surplus right now, and that may not last forever.
Great. Okay. Very good. That's really good. Thank you for that. Hey, Tony, what does next week look like for you? I know we've got CPI coming out. What are you looking at for the week ahead?
I'm thinking like Carl Icahn, to be honest with you, Tone. No, I'm serious. If you saw his options play, I guess he's got, it's 5 billion notional of options that are struck at 40.50 for next Friday. If you ask me, he's looking at a couple things. He's looking first at, I think, the bond market, the credit markets, in terms of the bonds and break evens, in terms of yields and break evens trading higher in the last week. They have both vaulted off of the lows, right? So there's been a clear turnaround in market-based inflation perception. So I think that he sees that and looks on the calendar and sees CPI and PPI next week, knows that, inflation is not linear in any direction.
Right.
And maybe is making a bet on, and maybe it's just a hedge, but maybe investing that money on the idea that we have an upside surprise in any of the economic data. The bond market tanks, stocks tank, if rates go higher, they're going to mash big tech again. And he's probably going to be in the money on his 40-50 puts. So, that's how I'm looking at it. I'm looking to see if my portfolio of trades that I've got on can weather that type of storm. And if I'm out of the way in certain places, if I should join him in certain places. Yeah. So that's the way I'm thinking about next week, man. I'm trying to stay alive.
Sounds very exciting. Tracy, what are you looking for next week?
Continue obviously watching the commodities markets, metals, energy, watching China data, the mobility data, flight data, see, how this is moving along, and we'll see how that pans
out. So if we see a higher CPI, what does that do for crude prices, do you think? Do you think that there's a direct impact?
I think you're going to see crude prices go higher.
Okay. Yeah, Tone, what a dynamic.
Counterintuitive, right? But
yeah, it's kind of like the markets speak to each other, right? Like a dynamic that we definitely saw along the way of the commodities rally as rates went higher last year, right? Call it the whole period going into the Russia-Ukraine invasion, right? It was oil straight up, but it was kind of like the credit market. I call 2-year yields last year the bat signal, right? And I named them that because they were getting out ahead of commodity inflation, right? And yield, we were having weeks where the bond market was getting shellacked and there wasn't much going on in the commodity markets, but all of a sudden they would pick up at the end of the week. And I think it was a lot of the time, like, the bond market signaling inflation here, the commodity markets are going to go up. And I think that that's kind of, a sort of a cadence that established itself. you know, and so it's going to be really interesting to see how that unwinds.
Fantastic. Okay, that's a really great explanation, Tony. Thank you. Guys, thank you so much. I really appreciate your time. Thanks so much. Have a great weekend and have a great week ahead. Thank you.
Thanks for having us, Tony. Be good, buddy.
Thank you.